You pay off a credit card, close the account, and your score drops. Carry a small balance month after month, and it climbs. 65% of your credit score rewards how reliably you stay in debt, not how close you are to financial freedom. The system was never built to measure your wealth. It was built to measure how profitably you borrow. And that misalignment can cost you over $70,000. Payment history sits at the foundation of every major credit scoring model. Whether it is FICO or Vantage Score, the record of how reliably bills are paid on time makes up about 35% of the total score. A single late payment can linger on a report for up to 7 years and drop a score by as much as 60 to 110 points. But a long stretch of on-time payments, month after month, year after year, steadily builds what the models call positive payment history. This is the behavior the system rewards most, not being debt-free, but proving you can manage recurring payments without a slip. Right behind payment history is the amount owed, or what the industry calls credit utilization. This factor carries about 30% of the scoring weight. Utilization is simple math. Take the total balance on all revolving accounts, divide it by the total credit limit, and multiply by 100 to get a percent. For example, Jamie has 3 credit cards with a combined limit of $15,000 and a total balance of $1,200. That is an 8% utilization rate. The scoring models treat anything under 30% as healthy, but the real sweet spot is below 10%. The lower the percentage, the better the score responds, so long as there is some activity. Zero balances across the board can actually stall score growth, while a small, well-managed balance keeps the system happy. These two buckets, paying on time and keeping utilization low, together make up 65% of the score. The formula does not care if you are building savings or paying off debt completely. It cares about how safely and predictably you keep borrowing month after month. That is the logic that drives the day-to-day reality for anyone trying to optimize their number. The length of your credit history quietly shapes your score, even if you have never missed a payment or carried high balances. Scoring models calculate the average age of all open accounts, rewarding those who keep long-standing credit lines active. For example, closing a 5-year-old card can shave a year or more off your average, especially if your other accounts are newer. This subtle math explains why closing an old, paid-off card often triggers a dip, even when it seems like the responsible move. New credit activity also matters. Each time you apply for a loan or credit card, a hard inquiry appears on your report. FICO and Vantage Score both count these inquiries for a full year, but they use a 14-day window to group similar applications, like multiple auto loan quotes, so rate shopping does not count against you more than once. Still, a cluster of unrelated inquiries can knock several points off your number, and opening new accounts comes with a short-lived penalty that fades over 2 to 3 years. Not all scoring models treat these factors the same way. FICO's classic versions calculate average account age and penalize new inquiries in fixed ways, while Vantage Score blends age with account mix and is quicker to recognize alternative data like on-time rent or utility payments. For renters who do not use credit cards, Vantage Score 4.0 can add a handful of points for steady rent or phone bill payments, though the effect is modest, usually just 2 or 3 points. These tweaks mean that 2 people with identical credit files can see different scores, depending on which model a lender pulls. For consumers, it is a system that rewards keeping accounts open, limiting new applications, and understanding that even small model quirks can move the needle. A difference of just 1 percentage point in mortgage rates can quietly reshape a family's financial future. For a $300,000 30-year fixed mortgage, a borrower with a FICO score above 760 might qualify for a 2.7% rate, while someone in the range from 660 to 720 could be offered 3.9%. That gap adds up to more than $70,000 in additional interest over the life of the loan. The impact is not just theoretical. Consider two homebuyers, Case A, who maintains a high score and locks in the lower rate, and Case B, whose score lands in the good but not excellent band. Case A's monthly payment is about $1,216 before taxes and insurance. Case B pays $1,416, a $200 difference each month. Over 30 years, Case A saves enough to fund a child's college tuition or boost retirement savings. The lower payment also means Case A builds equity faster, accumulating wealth instead of sending extra dollars to the lender. But the story does not always end there. Case B, facing higher costs, may stretch to afford the same home, putting less towards savings and more at risk if finances tighten. The spread between rates does not just reflect risk for the bank, it shapes the borrower's path to financial security. The advantage of a high score is real, but it is double-edged. The system rewards those who keep borrowing, and the biggest savings come only when debt is managed, not eliminated. For many, the price of access is a lifetime of payments, sometimes saving money, sometimes just moving it from one pocket to another. A former credit card executive once described the ideal customer as someone who revolves a $100 to $300 balance at 20% annual percentage rate, pays on time, and never defaults. For banks, this is the sweet spot. It is enough debt to generate steady interest, but not enough risk to trigger losses. On a modest balance, the issuer can collect $20 to $60 in monthly interest, plus transaction fees every time the card is swiped. Add in late fees, over-limit charges, and balance transfer costs, and the revenue stream grows, often outpacing the expense of servicing the account by a wide margin. This business model shapes the very logic of credit scoring. The formulas reward regular, low-balance usage because that is what keeps accounts profitable. A cardholder who pays in full every month generates only interchange fees, a fraction of what a small rolling balance brings in. But someone who stops using credit altogether, or pays off and closes old accounts, becomes less valuable to the system. That is why scoring models tend to penalize zero balances and closed accounts, nudging consumers to keep lines open and lightly used. Regulators have taken note. In 2025, the Consumer Financial Protection Bureau flagged the opacity of credit scoring models and the potential for black box algorithms to reinforce issuer profit motives at the expense of consumer clarity. The Bureau's warning pointed to a system where the rules are both complex and hidden, making it difficult for even the most diligent borrowers to understand why certain behaviors, like carrying a small balance, seem to help more than they hurt. The result is a credit environment where the safest path for the consumer often aligns with what is most lucrative for the lender. Start by pulling your free annual credit report from each of the three major bureaus: Experian, Equifax, and TransUnion. This lets you spot errors or fraud and dispute mistakes before they hurt your score. Next, keep old credit cards open, even if you rarely use them. Charging a small recurring expense, like a streaming subscription, and then paying it off every month keeps the account active and benefits your credit history. For utilization, aim to keep each card's reported balance below 10% of its limit. If you are close to that threshold, call your issuer to request a credit limit increase. Most banks allow one request per year, often without a hard inquiry. These moves do not require extra spending or new debt. They simply work with the rules of the system to keep your score in top shape while minimizing risk. Two major reforms could make credit scoring fairer for everyone. The first is asset-based scoring, a proposal now under review by the Consumer Financial Protection Bureau. This model would count savings balances, rent, and utility payments alongside traditional credit activity, helping millions who pay bills on time but lack credit cards. The second is a disclosure mandate. Since January 2025, Lenders must provide a clear 4-point summary each month explaining which factors changed your score. Meanwhile, bills in Congress aim to force credit bureaus to reveal exactly how scores are calculated and let consumers correct their data directly. Anyone can support these changes by contacting their representatives or submitting comments on the CFPB proposed rules. Real change starts with public pressure. Today, credit scores still decide who pays more and who gets access at all. As lenders automate more decisions, that number shapes real lives, not just loan offers. The real measure is not a score, it is freedom from debt. The question is, will the system ever reward that? Share your thoughts below.